Hi everyone, welcome to another episode of VCTV. Myself, Vandana Tolani, I would be moderating today along with our esteemed panelists, Frederick Sandwell, who would be giving us insights on preparing a business for exit. To start with, I would like to start with a brief intro about myself. I was in Singapore and Jakarta for 15 years in investment banking. I had my own family office fund there. This is my seventh year back in India. I did investments, then I went back to advisory. Currently, I'm connected with 300 investors globally. We pick up global deals. I've given an 160 plus talks all over the world. I'm selected as the top 10 women leaders in wealth management 2021, and my brand Convanto comes under the top 10 women entrepreneur brands. Very happy to moderate a panel on VCTV, and it's my favorite thing to do as well. Coming to Frederick, it is very nice to have you on Latukun VCTV. Could you kindly give an introduction about yourself so our audience can know that uh, who you are, etc.
Absolutely. So my name is Frederick Sandvall. I'm born in Sweden. I've been working in almost 50 countries, including living in India, where you're from, Singapore, where you used to be. And I like to help others. So also I'm doing quite a lot of advisory at the moment, more exiting and selling off companies than acquiring. And my main base of business has been United Kingdom, but working very much on a global reach. So I really look forward to today's topic, how to exit a business, because I have been working a bit with that over the last 2 years in particular. So yeah, here we go.
Yeah, very excited. This is also a very good topic. Topic is how can we prepare a business for exit? So, the first step should be, this is what I feel. The first step should be prepare your finances. The first step to develop an exit plan is to prepare an accurate account of your finances, both personally and professionally. The business should consider their options. Once you have a complete picture of your finances, consider several different exit strategies to determine your best option. But love to hear your thoughts, Frederick. How can we, how can a business prepare for exit? What are your thoughts on it?
So again, depending on the size of the company, this varies hugely. So I'm mainly been dealing with mid-size companies when it comes to exits. Same with small businesses, and there it's quite common that the main business owner, main shareholders, their affairs are very much intertwined, including my own case with the business, which means one of the first steps after doing what you said, doing the forensic accounting on your own company, because it will be done by others later, is to strip out unnecessary costs. It is to take away personal expenses, semi-business personal expenses, which might have been in the company, which means now we start to increase the profitability. Same thing here, you can try to optimize the performance of the business for the time of the sale. I can carry on for a very long time, but getting the business owner's affairs out of the business, one thing, start to think about how to optimize the timing of this. And often this is a 2-year exercise at least. It can be done in weeks, but usually it's a multi-year affair where you have specialists involved or not. But we'll come back to that in a second. So yeah, what's your own experience? Well, what else?
Uh, apart from what I spoke a bit earlier, I think we should speak with our investors, like approach your investors and stakeholders to share your intent to exit the business. Create a strategy that advises the investors on how they will be repaid. Uh, Once you've decided to exit your business, start transferring some of your responsibilities to new leaderships while you finalize your plan. Also telling your employees, when your succession plans are in place. Share the news with your employees and be prepared to answer their questions. And also, to inform your customers. Uh, and finally, tell your clients and customers if your business will continue with a new owner, and introduce them to your clients. If you're closing your business for good, give your customers alternative options. This is what I feel. I mean, also, I would like to know, Frederick, what are the challenges that these business face when preparing for exit?
I would say that the timing of all the things you just mentioned there, when to do that, that's really, really hard to decide. Like how much should you do in the background, how much should you involve ultimately the closest team, and when can you actually tell the customers? That's a tough challenge to consider, because ultimately, if you want to sell your company, you don't want, for example, your employees to jump ship because they feel uncertain. And this can be very much mitigated by information sharing, but the timing of that is essential. What you said there, another huge challenge is often the leadership could be equal. Frederick equals this company. That is not a desirable solution, because then it's much, much harder to change the leadership. So I would very much also, like you said, agree, try to get a new management in place, show that you are actually not necessary for the company. Otherwise, and often even if that is the case, you will be locked down into the company for X amount of time. For a very common expression is an earn out. So you are actually stuck in the business for X amount of time to deliver, for example, some performances. And that is unfortunately a time where the new owners can trick you to get less money for the company.
Totally get that. Like, I would just share some of the points that I have here. The challenges that businesses face when preparing for exit are forming an exit planning team. Like, it can be challenging to come up with a well thought out exit strategy. Forming an exit planning team that is experienced with structuring deals, particularly deals that involve exit strategies for business owners that will prove to be mutually beneficial for all parties involved. Now, the exit plan should include increasing the overall net worth of the business, among other factors. And also, it can be challenging to bring on an investor in case the exit strategy involves not selling the business outrightly, but bringing on an investor who could take on part ownership to help get it to a profitable, healthy state. It can prove to be another challenge. Typically, investors not only bring investment dollars, but they also bring expertise to the table. They work with others who are capable of improving the performances of, of the business, like carrying out a financial modeling and valuation strategies. I feel is very, very important. Since a model isn't a predictive tool, it is an analytical weapon. It delivers results under assumed scenarios. It cannot recommend anything, but it combines all input data to generate financial statements, charts, and KPIs, which will let you make decisions. It can also be very challenging to pull together the right information and making right decisions to assume the adequate values to unknown values such as growth rate, future market behavior, inflation, and in general, exogenous variables. Would you like to add anything to this as well, Frederick?
Yeah, I like to add the valuation aspect of things. So
Yeah.
sometimes it's absolutely the right thing to pull in like a third party to assess the value, because they might see things which are not noticed by yourself because you're sitting right in the middle of it.
Yeah.
And also, if there are any kind of like conflict linked to the exit, for example, someone is going after your personal estate or something like that, then you need to have evidence that the value of the share transfer, for example, might have done at the right price. So by engaging specialists, they have often got like an insurance for the company, like indemnity insurance. By working with other for example, everything from accountants to specialists in valuation, that can be a little bit of an insurance for yourself for the future. So that's like a very unusual way to consider, but it's absolutely important. And how will you deal with your existing investors in the company? Because they might be along the ride for your personal sake. So you might have put them in to the company, and that means that what will happen to them? Will you also allow them to do a financial exit or not? What do they want? So have multiple stakeholders in mind. And also in preparing your business for exit, often it is better to have less shareholders. Why? Because the new owner usually would like to have it clean and easy. For example, share options can muddle the picture, while they would like to keep things easy, like to have control. They like to know exact number of shares. They like to know the other owners. Otherwise, they might not consider to invest into the company at all.
Yeah, totally agree with you. I see Anuj here. Welcome, Anuj, to Latukon VCTV. I and Frederick were just discussing a few things about preparing a business to exit. Since you've just joined in, I would humbly request you to introduce yourself.
Absolutely. So, pleasure being here, Vandana. Quick introduction. So, being a startup founder, started 3 startups in the past. Most recent was a company called Skiwi. We took an exit from that in 2018. And since then, we have been working with other startups, other entrepreneurs, and running this startup boutique firm called Yellow Sapphire Technology. So, helping out other founders now, trying to give back to the community. So, yeah, happy to be here.
Good to see you
Uh,
again.
Good to see you again. Anuj, so far we have just carried two questions. If you could quickly tell us your views on how can a business prepare for exit? And second question is, what are the challenges that these businesses face when preparing for exit?
So, exit is is a complicated idea for most founders. When starting a new firm, more often than not, you would see a founder just falling in love with that idea. So,
Hmm, hmm.
just like a traditional business, they see that as an opportunity that, hey, if I work on this well, this will make me money in perpetuity, and I don't need an exit. This is something that I will do full time. And while, of course, that approach is okay for a lot of people, I mean, there are traditional businesses that have been going on for generations. There is always that factor of uncertainty involved, which a lot of these entrepreneurs are not taking into account. Let's be real here. Uh, let's be real here. The future is uncertain. Times change. Uh, there used to be an era where horse carriages used to be a good option. It was a great business to have one. Not anymore, right? Now you would, if you really want to have a similar business, you'd probably be driving with Uber or something like that. Likewise, there used to be an era where plastic production was a great business, where was a great opportunity. Before that, pet productions, there was a glass ball. So industry change.
Yeah.
I think we're getting a call, Vandana.
No, no, sorry, the phone was ringing. Sorry. Yeah.
No. So industries change, times change. That's why it's important for a lot of founders to make sure that they have an exit option, that
Hmm,
they
hmm,
can get out of that business at its peak where you're getting the most ROI. There
hmm,
is
hmm.
there is courage in staying in perpetuity. There's courage in staying in long term, but at the same time, let's make sure that we get what's best for ourselves, what's best for our investors. Hence, it's always a good idea to have an exit strategy in mind as soon as you start the business. It's always a good idea to sort of have some hint as to when you're gonna move out of this business once time comes along. So, for example, when we started Skiwi, we knew that upon reaching a certain point, upon reaching a certain threshold with our number of transactions we would be taking an exit. But over the next 2 years, we realized that, okay, there's going to be a glass ceiling that will hit in India in the current market. Yes, of course, we could have stayed, we were profitable, and we could have continued with that business for quite a while. But the reason why we exited a profitable business, why we sold off our accounts, why we sold all of our intellectual property, is because we realized that if we stayed, number one, we we would be letting go of a big payout that we are getting right now. Number two, I would be letting my opportunity cost to not pursue any other business or not pursue any other startup would be much higher if there is a glass ceiling that I know I can't shatter in the next 5 to 10 years because of the prevailing market conditions. It's always a good idea to move out, even if you're making approximately the same money through that exit. You still have then that opportunity to pursue something else and then make an even bigger amount.
Yeah, I get it.
Hence, exit for a founder becomes a very important factor that they must always must always stay in the back of their head. It doesn't have to be something that you constantly think of, because being very honest, the moment you're thinking of an exit, that's when you probably lost your faith in your business. But it must always stay at the back. That way, you know that, okay, once I'm at my peak, it's just when I want to move out and when I want to pursue other opportunities. In other sense, let me get the best ROI on the time, on the effort that I've placed in pursuing this venture. Let me get the best ROI on the opportunity cost that I spent to pursue this startup. And once I've recovered it, let me move on to the next one.
I get it. Patrick, would you like to add to what Anuj said, or shall we move to the next question? Yeah.
I can just mention a couple of things. I really like what you're sharing there. Very valid points to expand on some of them. If you have a business and you begin with the end in mind that you are preparing to sell in due time, that means if you have got a company which is sellable, that means affairs are in order, accounting is in order, things are more up to date. Otherwise, I know quite a few companies which have not got their things in order, which means it's very hard to sort out a backlog. And also, it is good practice to have things in order. And usually that is not the main priority for the entrepreneur. So usually the entrepreneur need to have a team tidying up behind them with the details, which are very often required as well.
Great insights coming from you both. My next question is, when should a business decide to exit? So, Patrick, going back to you, what are your thoughts?
I'd like to just show the whole company for sale market globally. At this time, we have got a huge surplus of companies which really should be sold and also will eventually die, with the founder being relatively old. So old companies, old technologies, not looking too far into the future, which has got potentially a huge value. But there will be a surplus of companies. I know of quite a few people who are very much hoarding other assets, more of acquisition companies, and they become worth quite a lot. But they need to maintain the speed acquiring companies, otherwise they will also lose value and interest from investors. That's not really respond to your question, but that's a huge trend in the market, that there will be a surplus of companies. So if you're out buying, you can really make some discount deals out there. And many companies might not have a role in the future either, because they have not adopted. But those particular companies, together with an online sales function or better marketing, might have a huge untapped potential as well, because we need some of the old stuff as well, like food.
That's right. Anuj, would you like to continue with what Dr. Frederick is saying, and what are your thoughts?
So, I have a slightly different belief. I mean, as someone who has done things on both sides of the aisle, as a founder and as an investor, I don't think there's a right time. There really can't be a one size fits all approach. Uh, you can't say, oh, once you have done 100 billion in sales, fantastic, get an exit. No, that's not how this works. There are a lot of organizations where the potential was always so high that it never made any sense to get that exit. Take Facebook for an example. Uh, they got $1 billion acquisition deal, and they turned them down in a heartbeat because they knew that our growth right now is at such a pace that even this $1 billion is not enough. And look at their valuation right now. Yes, of course, they went public, but a lot of investors have not yet taken a complete exit. They're still holding on to their equity because they know that it can be higher in the future. And the same applies to every other company out there. You can't have a one size fits all approach. You can't say, oh, this happens, that's when I take an exit. It's all about keeping a close eye on the business. Uh, See, as Frederick said, you got to make sure that your affairs are in order. As founders, we we get so focused on putting out fires that, oh, something's wrong in this department, something's wrong there, that we lose sight of our accounts, of the unit economics, of the little things that matter. And the moment that happens, you are then just working on putting out that fire instead of focusing on growth, instead of finding that right opportunity, that right moment. So as a founder, keep your head in the game, delegate. That's the key word. Make sure that your accounts are in order, your affairs are in order. And as long as there is constant growth, don't take an exit until unless, of course, you want to. You think, oh, great, I'll probably make $1 billion out of this. I don't need more money. Fantastic, whatever works for you, man. But if you think that, okay, I have been growing 2x year on year and will continue to do so for the next 5 to 8 years, stay as long as you like. Every investor would love that.
Mhm. So, adding to both of your points, I have a few points as well. I feel business should decide to exit when there are uncertainties in the market. Like a declining industry can adversely affect your income stream. Political or economic crisis, destructive competitors, and changes in regulations can create a lot of uncertainty about a market's future development. Many entrepreneurs opt to sell their business during such circumstances so they can exit while they are still ahead. Another factor is compromised economic freedom. I feel the financial uncertainty amidst constantly changing business models can take a huge toll on business owners who often forsake the comforts of a fixed salary in order to realize their vision. In some cases, business owners recognize that too many of their commitments are tied into their business. And in these instances, they may choose to liquidate some of their assets and seek investors with resources to nurture the business and give it a chance to thrive. And another factor is your heart is no longer into it. This can be due to various reasons, but the reality of the situation cannot be denied. When the business is no longer a priority or the thrill of the challenge has diminished and the tenacity behind decision making has dulled, this is a clear signal that it might be time to exit and place the business in the hands of another. The last thing you want is for indifference to set in and affect your well being as well as that of your employees and partners. Another factor that I feel is the gaps within the business. Gaps in performance skills, product, and profit can hold back your business from growing to its full potential. Recognizing that you don't currently have the necessary resources to advance your business can compel businesses to seek out new investor management who have the tools needed to fill in these gaps and transform the business. Then, I also feel there are 5 Ds, like death, disability, divorce, distress, disagreement. Known as the 5 Ds within the exit planning industries, these factors tend to be the reason behind an exit roughly 50% of the time. In an ideal situation, most businesses will already have a contingency plan waiting in the wings in the face of either of these unforeseen circumstances. And to lower the risk of having to make any last minute calls that can result in a loss of your business planning ahead, and working closely with a team of trusted professionals can help you ensure the best possible outcome for you and your business. These were some of my thoughts that I had. um, so now going to my next questions, what are the different types of exit strategies that a business can opt for? Um, uh, could we start with you, Frederick, if that's okay?
Sorry, can you say the question again, please?
Yeah, sure.
You're
My
breaking up a
question
little bit.
is, what are the different types of exit strategies that a business can opt for?
I'd like to start with the most complicated one, which when a company starts, so many would like to sell their company on the stock market. A change of management and also putting the company on the stock market at the same time, and you also do your exit. That is usually not the best way to do, and it's rarely seen with a great success. So stock market massive exit is not a preferred one. So it is more around talking about how can you find the right buyer at the right time. So I wrote in the comment section here, when you run your company, think
Hmm.
about who might benefit from actually acquiring you. And usually, when you think about that, you think about the closest of your competitors. But often, if you can find a strategic buyer, which means you're now complementing maybe a portfolio of other interests, you might have a much higher multiplier. Otherwise, you must be as valid on your income. And also, often entrepreneurs are stronger in certain phases, for example, startup, growth, maturing, or even decline. So you might not be the right leader for the stage where you are. And I have personal experience from the same day we started to talk about selling one of my larger investments quite recently. The same second we started to talk about selling, I lost somewhat of the motivation to be in that company. Just I'd put in less effort, to be honest. So
Of
yeah,
course.
over to you, Anuj.
Yeah. Anuj, what are your thoughts?
So I'll share my exit story here. Uh, when we were working on Skiwi,
Hmm. Hmm.
exit was something that we knew we were gonna go for in the next 5 to 10 years. We knew that we want to make sure that we get return on these investments, not just make it a make the valuations on paper and it turn out to be paper millionaires. So we always have that idea in mind. But for us, the time came in, or the time we knew we were going to go for it, is when we realized that our India numbers have been stagnant for over 9 months. As we launched the company, the growth was practically explosive. We were one of the first concierge to originate out of Southeast Asia that was working at a level of American Express in an economy that's not very credit card happy economy. Uh, so the kind of service we were offering were pretty amazing. Uh, and since we launched globally from day one instead of just keeping ourselves limited to India, the the growth was fantastic. There was clients from Italy, there were clients from Southern Africa, Southeast Asia, in in Europe, Australia, everywhere around the world. But in India, we were stagnant for 9 months, and somewhere around the 7 month mark, we decided to reach out to our current users who had initially used our services or who were no longer our active customers. And we asked them, what's
Hmm.
wrong? Why are you guys not using the service? And very surprisingly, we got the Netflix reaction. Uh, when you offer someone a huge catalog like Netflix does, right? Hey, come on Netflix, you can watch anything.
Yeah.
What do most people end up doing? Scrolling and then just falling asleep. That's the same thing that happened with us. We offered such a huge catalog that our users was like, okay, but what do I use you for?
Yeah.
And that's when we figured, okay, there's that glass ceiling. There's where that Indian market is not ready while the global market is doing wonderful. So over the next 2 months, what we did was we started looking out at our competitors in other market that have been existing there. We were a very small player yet, uh, nothing compared to the likes of other organizations that have been working in UK or in Hong Kong. But that's where our opportunity was, right? So we decided to reach out to them since we had built a tech level as well that these guys have not yet deployed. We offered them two options. You can either choose our account or you could choose the intellectual property. Or, of course, you can buy everything as a package deal, right?
Right.
The intent at this point in time was we want to get out of this, not because we have lost the passion, not because we don't believe in the problem statement, but because the market is not ready. And hence, we ended up selling to three organizations. We sold off our American and European accounts to this organization based in UK, Southeast Asia, Australia, and African accounts based to an organization in Hong Kong. We sold off our intellectual property to a company in South Africa. That's it. From that realization to actually getting money in our bank account, it took us roughly 2.5 months.
Oh.
But that 2.5 months was a very crucial period for us. And then the reason why we could do it this fast is because we always had that unit economics in our hand. It's always because we knew the key metrics in every demographic, in every country, in every geographic region. And hence that number, when presented to another organization, made a no-brainer for them.
Yeah.
So yeah, I think that's the approach that needs to be here as well. You can't say, how do I find that right time? How do I find that right buyer? It's always right there. It's always right there in the books. Again, no one size fits all approach. You gotta make sure that you do what's best in that current situation.
Thanks for sharing that use case. So, I have some different types of exit strategies, and I feel the first option is to give exit to the investor through an IPO in approximate 5 years, getting the company share listed on a stock exchange so that with the liquidity coming through trading of shares, the investor can sell his shares anytime partially or fully. If IPO is not possible, then the company should appoint an independent valuer of the shares and find a third-party investor who will buy the shares from the original investor. The new investor should buy shares at the price which will give the required IRR, internal rate of return, to the original investor. The IRR asked is usually 20 to 25%. Now, if the second option is not possible, then the company should buy back the shares from the original investor by giving him the required IRR. And if the third option is not possible, then founders should buy back the equity from the original founder by giving him the required IRR. And if all of the above doesn't happen, the company should look for a strategic partner, one who buys a big stake in the business as a strategic investor and not as a financial investor, and hence gives the exit to the original investor. Now, coming to my fifth question, why is an exit plan important? Like, why is it so important? Frederick, I would like to ask you this question.
So if you've been alive a while, you know that a plan is just a plan and nothing else. But by having a plan and maybe contingencies, maybe options, then you're more likely to even apply it. And you also will start to do the right actions in the right time. So I like plans, but I'm also very aware that they often change. But if you do work without plans, then it will most likely turn into that firefighting and forgetting the exit as a main focus event that you maybe should have.
And what are your thoughts on the same, Anuj?
So There is this quote from Muhammad Ali, I guess. Uh, Everyone has a plan until you get punched in the face. And I think this applies perfectly here. So,
Hmm.
like I said, exit is something that there always has to be the back of your mind. You can't plan for such a thing. It's a contingency. It's uh, it's your best case scenario. That's why the 5 or 6 situations that you explained, hey, here is how you should take an exit. It's sort of very theoretical, right? Uh, at the end of the day, if I'm building a venture where, let's say, I've raised $100 million, the investors would only want an exit when the business is not doing well. And if that is the case, obviously the founder would not have money. Hence, at such a situation, buying back that equity or listing yourself as a public organization might be a pain in the ass. So,
Hmm. Hmm.
at which point, what would you do? You look for an asset management company, sell off your holdings, and then just be on your merry way. Uh, but doing so is not an easy way either, right? They would probably want to buy that company at a hugely discounted price, which would probably piss off your investors, which would probably screw the returns that you're going to get on it. Hence, yeah, that Muhammad Ali quote, right? Everyone has a plan until you get punched in the face. I may say, all right, this is what we're going to do. This is how we're going to get to XYZ. And at 500 million monthly revenue or 500 million yearly revenue, we'll go for an exit. We'll either publicly list the organization or we'll make sure that we exit XYZ way. Who knows? You might be in a WeWork kind of situation, right? Keep that plan, but at the same time, keep yourself current to the market. Uh, Exits only happen when everything falls at the right place at the right time. So time's of the essence. It's when the time's right. Pick and choose your opportunity, pick and choose your moments, and then do the best that you can do.
Yeah, agree with you. I feel it is important to consider an exit plan, even if you do not intend to sell your company immediately. For example, there is a personal health issue or family crisis. You may be affected by personal health issues or experiencing a family crisis. These issues can take away your focus effectively from running the company. And an exit plan would help ensure the company would run smoothly. An economic recessions can have a significant effect on your company, and you may want your company to avoid assuming the impact of a recession. And also unexpected offers. Large players may look to acquire your company even if you do not have any intentions of immediately selling the company. You would be able to have an insightful conversation, if you have thought of an exit plan and a clearly defined goal. By having a well defined exit plan, you will also have a clear goal, and an exit plan has a significant influence on your strategic decisions. Coming to my last question, what are the mistakes that companies make when looking for exiting strategies? And what are your closing thoughts, and where could one reach out to you? Anuj, since you have to leave, I would request you to take the lead here.
Sure. So, closing thoughts. Uh, Times are changing, markets are changing. I feel that the decade that we are entering right now, this is going to be the decade that would push the already flourishing economy into the next phase. So countries like US or Canada or the whole of EU would see a complete shift in their focus where they're moving from traditional fossil fuels to clean energy resource. Meanwhile, growth economies like India, China, Southeast Asia, Brazil, these economies are going to see a sudden burst in their growth numbers where the ROI that investors are going to get is going to be huge. And at the same time, other regions like MENA or Southern America, they are going to experience what India and China went through back in the 90s.
Hmm.
This
Hmm.
The next decade is a decade of shift where a lot of things are going to move, where a lot of things are going to evolve. So anyone who's starting right now is starting at a wonderful time. we always have FOMO, right? Oh my God, why didn't I buy Bitcoin when they were just pennies? So to anyone out there who's watching, this is your chance. Go ahead, make an investment, start something amazing. And then once you reach a growth number, make money for everyone. Uh, something that was taught to me by my mentor very early on in my career. To make wealth for yourself, you got to make sure that you're generating wealth for others who are with you. To make money for the company, you got to make sure that there is money that's being made for the employees, that's making money for the contractors that are working on it, and of course that's making money for the people who are actually using it, not just in terms of, oh look, I built a SaaS organization. It can't make money for them, right? But it can save money for them, and then money saved is money earned.
Yeah.
Hence, when you do that, that is when you're going to get the appreciation, that's when you're going to get the growth. And as that happens, keep that close eye, make sure that you pick and choose your right opportunities, and then get out there and do something amazing in the market. So to anyone who would like to reach out to me, you can find me on LinkedIn, Anuj Chauhan, or you can look me up on Twitter at Anuj. I'm fairly active. Reach out to me, always happy to help out.
Thank you, Anuj, for coming here and sharing your precious time and insight.
My pleasure.
Frederick, my last question. What are the mistakes that companies make when looking for exiting strategies? And what are your closing thoughts, and where could one reach out to you?
I would say the biggest mistake is to forget about the exit and not have it in mind.
Okay.
That means that once you get that offer, you're completely unprepared, your business is unprepared, and you will most likely not at all get what you wish. So yeah, that's the biggest mistake, I would say, to forget about the exit while you run the company. I would say key things. I believe in luck, but I also very much believe that you can influence your own luck. The majority of business exits, as well as the best startups, have been extremely lucky. Why? Because of the timing. And that is just a huge thing. The timing and the luck factor is things. I completely agree with what Anush said about do good for more people than yourself, including staff, customers, extended customers, and think about how they will benefit. I really agree with that. And also think about, will you focus on quality or quantity? So that means you can quite easily calculate how fast you can grow. You can figure out metrics so that you can actually think about that exit. So if that is more of quality, that means that you might have reached R&D goals. It might be, if more of quantitative, it will be very much sales metrics, etc. So yeah, I would like to invite people to connect on LinkedIn in particular. That's where I was most active. I do have books that people can find and so on, but if you just Google my name, and you will find some relevant things if you want. And thank you for having me as a guest.
So thank you, Frederick. I have some closing thoughts as well. We'll just take a few minutes. So I feel an exit plan may be used to close down a non-profitable business, execute an investment or business venture when profit objectives are met, close down a business in the event of a significant change in market conditions, sell an investment or a company, sell an unsuccessful company to limit losses, reduce ownership in a company or give up control. I could be reached out on my LinkedIn handle or my website, www.convanto.com. And once again, Frederick, thank you for sharing your precious time and sharing your insights on this panel. The audiences who are listening to us, please tune in again. We are having lots of Latukan VC TVs that are coming up with wonderful panelists who will be sharing their insights on VC TV. Thank you once again, the entire team of Latukan VC TV and Frederick. Have a good day.
Take care. Bye-bye.
Bye.